Dennis Leibowitz with us from Act 2 Management, who I knew years ago at Donaldson Lufkin Generate. Craig Moffett, my guest host this hour. We're going to skip the data, check the market down 25 points, nothing going on. Here is a chart, Dennis, which underscores Craig's sensitivity to the income of Americans. Here it is, our national anxiety is just real personal disposable income. Craig, you can see it down here. And there is that straight line up of cable supremacy, and we've all gotten a little tight with our money. Dennis, how do you respond to Craig's idea that cable and satellite have a poverty problem?
Well, I think the decline in cable subscribers is primarily because of that, and as Craig said, not because of defections to Netflix or others. The companies are making up for it to some extent by selling advanced products to the video customers that are left. So the net result, has been a modest increase in video revenues despite the loss of subscribers. But most importantly, the cable industry, as I know Craig has written often about, is really growing. The prime product is the data product, not the video product.
Larry Haverty said this morning there's use of cash is better within media. Is the arrogance been kicked out of the cable business, Craig? And I'll ask both of you this question. Is it a little bit more humble business now?
Well, the growth rate overall has slowed down. The mix has changed in a favorable way. Arrogance, I don't know if that's the right word, but I think one of the defining reasons that we're positive on the group is that the industry has moved to substantial free cash flow generation and use of that, a substantial portion of it, to pay back to shareholders through share repurchases and dividends.
What you just heard from Mr. Leibowitz there, folks, is the way people in the industry talk. They talk about cash generation and use of cash. It permeates the research reports. Bring up here a Moffett Black Book comment here. Bring this up if you would, Rex. A poverty problem for more than a decade, real growth, despite the most audacious innovation, was stifled by a combination of flat real incomes and stagnation. Craig, I want you to ask a question of Dennis here, but first, when you look at this poverty problem and the need to generate cash, is that cash generation at risk for the cable providers?
Well, I think Dennis is right when he says for the cable providers, the core product is now infrastructure, right? And I've had this message on your show, and I've been saying this for years on Wall Street, that it's important to remember that the cable companies are not media companies anymore. The cable companies are infrastructure providers. They are effectively road builders, and they are in a very attractive position because they own the road, and it's a road that we all need. It is the bits and bytes that are coming into the home, whatever they're used for. And in that sense, they are extraordinarily lucky that they are growing nicely in a product that still has some penetration legs to it and some price realization. The media part of the business, though, is what the old legacy core product of video faces real challenges. The price of the content is going up. The NFL is likely to sign its deal this week. It's a pretty safe bet that the next time they sign contracts, the rights for the football league are going to go up, rights for basketball going up. Sports keeps pushing prices higher. So do all the general content networks that feel like now I can sell it to Netflix, and that makes it even more valuable, and I can charge more. You're seeing real escalation in this business.
Ask a question of Dennis.
Well, so you are putting your money where your mouth is and making real investments. I guess the real question for me is, there's the age-old content is king, distribution is just a commodity. But which do you like better? Would you say I want to be in content or I want to be in distribution?
If you just ask that question generically, I'd rather be in content because they're increasing buyers for that content. That doesn't relate to the valuation of the companies involved. And as you know, most of the major content producers derive most of their income from their cable networks. So playing content on a pure basis is a little bit more difficult to pinpoint.
Well, bring it up here. Here's a chart. We had this. We didn't know what you were going to say, Dennis, but we like to adapt to what our wonderful guests say. No, that's not what I want. I want the other elegant chart. We're going to use that one in a bit. There it is. Content beats network. And this is the debate. Do you buy News Corp, which has outperformed from the bullish bottom, or do you go with Comcast more, as you say, an infrastructure play? Who wins here, Craig? Content or network?
See, I've always thought that I asked it almost facetiously because I think it's the wrong question. They're fundamentally different types of businesses.
Correct.
The content business is more cyclical.
Yep.
The distribution business is less cyclical. The content business is lower capital intensity. The distribution business is higher capital intensity. So they move on very different rhythms and different cycles. That said, I think, to me, a more relevant question is, and I'll ask this to Dennis, is you look at the telecom sector too. When I think about the real distribution businesses, would you rather be in cable distribution or would you rather be in telecom distribution? That is, the big telcos or the big cables?
Oh, definitely the big cable companies. I mean, one of the key differences is that the ratio of capital expenditures to the total, which is producing this great cash flow in cable, is declining. For the telephone companies, it's going the other way.
It's going the other way. They got to catch up, build up.
And the wireless business is very competitive. You know, even with the great growth in wireless data, the decline in their other businesses and price competition is eroding that when you get to the bottom line.
Here's the elegant chart on it. I was surprised by this. Verizon outperforming AT&T a little bit. Craig, you and your team have done this. I know Robin has written you up in Bloomberg Business Week a little bit on this. Do you pick between these two, Verizon and AT&T, or do you just walk away and go have more fun with News Corporation? I'm asking both of you.
I don't know if you call that fun, but go ahead.
Well, look, these companies tend to trade in parallel. They tend to be viewed as defensives, and so they tend to trade pretty close together. And as you can, there's been a little bit of separation, but over time there tends not to be much. The interesting thing, and we've done a fair bit of work on the theme that Dennis was talking about of capital returns, is that the return on invested capital on a blended basis, so that is, remember, these companies are still half wireline or the traditional wireline business, that on a blended basis, these companies are barely earning their cost of capital. AT&T is somewhat above the cost of capital, and Verizon, surprisingly, is actually earning less than its cost of capital. And that provides, I think, some very important and compelling insights into valuation, because a company that is earning exactly its cost of capital ought to be worth the sum of its capital. That is to say, a dollar that's earning the market return ought to be worth $1, no more, no less. Verizon's invested capital is worth about $20 a share.
Earlier this morning on Bloomberg Surveillance, Bloomberg Radio, I spoke with Larry Haverty of GAMCO, and I asked him if media companies are deploying cash or hoarding it to build the next innovation or network.
The best example of this is DirecTV. They have been aggressively buying stock. The other one who seems to have gotten religion is Viacom. Time Warner has bought stock aggressively, and Comcast has also joined the party. I used to joke about Comcast that they never saw a dime of free cash flow they couldn't spend or lever.
What a change. What Larry Haverty there, and you mentioned this earlier, Dennis, is like a whole new religion. These are not utilities anymore. They're really moving the cash around, aren't they, Craig?
Well, in some ways they are utilities, and I think they're starting to act a bit like utilities in the sense that they're returning cash, and that's exactly what their investors have wanted all along.
Which is your favorite cash returner? Which is the management that gets the Leibowitz religion?
Well, the most aggressive, as Larry pointed out, is DirecTV. I mean, at the rate they're going, if they keep their leverage targets and if they encompass the Latin American operations, they could buy something like 2/3 of the stock back in just a couple of years. So nobody is more aggressive than they are.
Rick says, would you make up a chart of DirecTV as you can? 10 years back. I want to switch gears here to Verizon and telephone. Let's bring up a Dennis Leibowitz note, if we could. Right now. It was just a research note from Act 2 Management. Cable system operators are capturing 60% of broadband data customer ads because of the advantage of their faster, whatever that is, DOCSIS 3 technology compared to the telcos. We all know whose slow motion DSL business is inferior. This is about technology still, isn't it, Dennis?
That's certainly a big part of it, and also the, Fios at Verizon and AT&T's Uverse are exceptions, but they have played out pretty much where they're going. But other than that, the traditional, yes, it is a technology advantage.
Ask a question here, Craig, please.
Well, I was just going to add that yesterday at a regulatory conference, AT&T CEO Randall Stevenson was quoted as saying that DSL is obsolete. Now, it's taken only very slightly out of context. He was talking about accelerating product cycles,
Sure.
but was acknowledging
We're
that
good
DSL.
at doing that here, so it's good to take things out of context.
But acknowledging that DSL is obsolete. So I guess but the real question is, so you've written about this incredible data wave that we're seeing,
Right.
and it's not just wireless, it's not just
Right.
wireline.
Right.
But where do you make money from it? I mean, where are the places to play?
I think the biggest way to play it is the tower companies, because it doesn't matter who wins between AT&T, Verizon, Sprint, Leap, Metro, or anybody else. The growth in data stimulates the need for more towers, and if new companies get off the ground like Light Squared or the spectrum that Dish Network has accumulated, it can't be anything but good for the tower companies.
Here's DirecTV. I want to show this chart quickly, as Dennis and both him and Mr. Haverty mentioned it. Look at that chart, folks. How many charts have you seen like that? The answer is not many. Now bring up the Leibowitz tower chart, if you would, Rex. That would be beneficial. There it is. Leibowitz says Qualcomm towers supreme. I found this chart amazing. This doesn't look like Intel, does it? It's a lot better chart over time. Tell us about Qualcomm a little bit, Dennis, before we let you go.
Well, Qualcomm basically has the patents that that affect almost all kinds of wireless technology, particularly the newer systems that are coming. So it's kind of like the towers in a way. It's kind of a neutral way to play the development of smartphones and the growth in wireless data without picking a winner, so to speak.
Right. Thank you so much for coming by. Dennis Leibowitz with us, folks.